Hello class. In this video, we're going to look at one of the harder things from chapter 14, and that is bonds with warrants. And so I've got some information up in the left corner of the screen that is given to us. And this will be very similar to a homework problem or a couple homework problems that you have. All right, so given our information that's available to us, I've gone ahead and just done the first journal entry. So let's talk about this. In this case, the bonds have non-detachable warrants. And what that means is that you cannot separate the bond from the warrants. So you can't detach them and sell the warrants on the market. When we have non-detachable warrants, the accounting is simpler. We simply take all the cash received from the bonds and we debit cash. We take the face value of the bond and we credit the bond payable by that amount. And then the premium is the difference. So that one's easy. The next journal entry is when we have detachable warrants. And when we have detachable warrants, we have two methods to deal with it. The incremental is one method. We'll start with that one. Okay, so with detachable warrants, they can be detached from the bond and they can be sold on the market. Or they can be kept by the investor, and those warrants enable them to buy stock at a given price. So it's basically like a call option, right? All right, so what we have is the cash that does come in is 6132000, same as the first entry. The bonds payable always has to be at the face value, the maturity value. That is 4.2 million. The next piece is figuring out how to divvy up the amount between the premium and a new account called the additional paid in capital, stock warrants. So basically, we are allocating part of this to debt and part of this to equity, and the APIC account is the equity portion. Okay, so what we did find out is that the fair value of the bonds without warrants was 1180. Now remember, a bond is at a 1,000 denomination. So we have fair value without warrants. And then what they were sold for is fair value with the warrants is 1460. Okay, so we're going to focus on this number here, the fair value of the bonds without the warrants. We're going to take that number times the number of bonds. We have 4,200 bonds. That's the value of the bonds without warrants. Then we subtract out the value of the bond. And basically this comes down to 4,200 times 180, and that's going to be the premium. And so we figure anything between the 1180 and the 1460 is additional money being paid for the use of those warrants. And so that actually, if you took the difference between those and multiplied it by 4,200, you would get what goes into equity. Or you can just figure it out as a plug figure, make sure our debits equal our credits. Okay, so you may need to rewind that and listen to it a couple times or read in your textbook to make this more clear. And then we're going to go over to the more difficult method, which is the proportional, and it's not bad once you get the hang of it. Okay, before we get right into the details here, but let me remind you, do you remember the lump sum purchase that we did in an earlier chapter when you bought a land, building, and equipment? And you had a one lump sum of money and you had to divvy it up between three different assets. This is very much like what you're doing here. The investor is receiving a bond and a warrant. And what we're trying to do is divvy up the value, the total amount of cash received, and figure out how much should go to bonds and how much to warrants. I hope that helps a little bit. So we have been given relative fair values. Now remember, bonds, we have 4,200 of them. Bonds without warrants are selling for 1180. So we're going to simply multiply that, and that'll give us the fair value of the bonds. We know that warrants, we have 92,000 of them, and they are being sold at $40 a piece on the market. And so we can figure out the amount that is allocated to warrants. Now we see the total fair value when we add those two together is $8,636,000, right? Well, that's more than that $6,132,000, the cash that came in. Very much like that lump sum purchase. We would have a fair value of all the assets, which would be usually higher than the amount of money that we paid. All right, so we simply take a fraction. We're going to take the bonds, that amount, divide it by the total. Find a percentage. And I'm pretty sure that my accounting lab is rounding to the 2, so basically it's 4 decimal places, but 2 decimal places after the percent. And then we'll do the same. We'll take the face fair value of the warrants, divide by the total fair value of the package, and we get another percent. Okay, so now we have our relative fair values. What are we going to do with this? We're going to multiply each percent times the cash we received. So there's our first one. And now this part gets a little complicated, so if you need to slow down and process and start over again, that's fine. We have allocated $3,519,155 to the bonds. Well, the bond payable has to be at $4,200,000. I mean, anytime we do a journal entry for issuance of bonds, it has to be at its fair value or maturity value. So that has to be there. But bonds payable plus premium or minus discount will give us the book value of the bonds. So basically what we have done is solve for the book value. We plugged it in here. Now we're taking the bonds payable and we're saying, what number do we need here to make the book value come down to $3 million and change? So I wrote over here to the side, must be a discount account. And I simply just take 4.2 million, subtract out that, and that's the amount of our discount. Okay, so that's the allocation of bonds. Now we'll do the warrants. We simply take the percentage times the cash received. We get that amount. Now we plug it all into a journal entry. We're almost done. Hang in there. All right, so here's our cash coming in, 6 million and some. The discount we figured out above is right over here. Bonds payable at its face value, and APIC stock warrants will be the amount we just figured out. Okay? Now, very last part of this question, because I know you have it for the homework, is assuming that the investors wanted to actually use the warrants. So they didn't sell them in the market, they kept them, and they're all going to cash them in on the same day. It's nice that it works like that, right? So what we do here is we show the cash coming in. Basically it's 92,000 warrants times $55. That was basically the call price. That was the amount that they said they could buy it for $55 a share. Doesn't matter what the market is. Next thing, APIC stock warrants, the exact same number we have here. We're converting that APIC account into something else. Common stock, it was 92,000 because it was $1 par, and APIC is the plug figure. Okay, so that's how the journal entry goes. All right. Hope that helps.